Today I'm speaking to Alex Svanevik, co-founder and CEO at blockchain analytics firm Nansen. Welcome, Alex. How are things?
Thank you. Things are going great. Interesting times in crypto as always. Happy to dive into the conversation.
Yeah, fantastic. I wanted to start with your background. We usually do this with all of our guests just to get an understanding of their context. So perhaps you can tell us more about your academic background in AI and machine learning and how it's informed your work at Nansen.
Yeah, absolutely. So I graduated from the University of Edinburgh back in 2010. I studied artificial intelligence. It turns out Edinburgh is actually, I think, has the oldest AI lab in Europe. So they've been doing this quite some time. Some interesting folks who were at Edinburgh, including Thomas Bayes, one of the fathers of probability theory. So there are lots of Bayesians at Edinburgh. The first thing I did after graduating was to start my own AI company in 2010. A little bit too early if we compare that to what's happening right now with AI. Back then, it was obviously not as hot as it is now, although data was quite big. So my career kind of went from co-founding that AI company, then understanding that I don't know enough about business. So I went into management consulting for a few years to learn more about business. And I worked with everything from seafood to luxury retail, banking, and insurance. And then I went back to my data roots as a data scientist and later on a data science manager, where I worked with machine learning in different contexts, everything from recommender systems to figuring out which users are more likely to subscribe to media products, using machine learning for pricing car insurance, and lots of different things. But in 2017, I discovered Ethereum and I fell down the rabbit hole. I realized that the intersection of crypto and data was a really interesting one where you didn't have that many people operating. So that ultimately led me to co-found Nansen a little bit later in 2019. And yeah, that's where we are right now.
Yeah, fantastic. I think that's a nice segue onto my next question, which is essentially, why did you build Nansen? Was there a eureka moment, perhaps?
Yeah. So when we started Nansen, I would say there was kind of a hole in the market. On the one hand, you had lots of kind of information products that were focused on retail investors like CoinMarketCap or Etherscan, that gave you, quite simple information. They were all either free to use or very cheap, depending on which products you were looking at. But they didn't really help you that much in surfacing alpha. They were kind of commoditized information products. On the other hand, you had some very expensive products that looked at on-chain analytics, but they were mostly geared towards anti-money laundering and compliance. So the canonical example here is Chainalysis. And we felt that there was a gap in the market for on-chain analytics for investing purposes. So being able to make sense of what happens on-chain and have that guide you in terms of your discovery of tokens, what are the either tokens or NFTs that you should be looking at, and then helping you with on-chain analytics to perform due diligence as well. For different assets. And not to mention defend your portfolio through alerts. For example, if a large player is selling a bunch of tokens that you are interested in or that you're holding. So we kind of carved out that middle ground where we could offer something that was more accessible price-wise than a Chainalysis to investors in crypto. And so the rationale was basically to kind of let the man in the arena actually get really advanced analytics tools. So that was kind of the market need. And then in terms of from a technological perspective, the insight we had also was that in order to do this successfully, you need to be really good at attributing addresses to entities and to basically help people understand that when you see an address 0x123 send $100 million to 0x ABC, that's not really enough. You need to say, hey, this is Alameda depositing into FTX or something like that, right? And to do that, you need to attribute entity information or behavioral information to the different addresses. So that's the kind of technological or data insight that we had, that we needed to solve that problem, and we didn't really think that people had solved it in a good way before. At this point, we have more than 250 million addresses labeled up through various different methods. And those addresses cover more than 80% of all blockchain activity for the chains that we support.
Yeah, fantastic. I want to get onto that labeling and that whole taxonomization process later on. But before we do, you mentioned that, no one was really doing this and that there was a problem to solve. Why do you think there was that gap in, information about the wallets transacting on chain?
I mean, crypto is still a very young industry. And so you had seen some of this already, but like I mentioned, either it was geared very much towards the kind of anti-money laundering and compliance use case, or the ones who were looking at it for investment purposes, they were doing it in a very, how should I put it? Not in a super methodical manner, which wasn't kind of ambitious enough to get to the scale that you needed to. So it was kind of, some people had tried to do it here and they had sort of 20% of the solution, and then another team had tried to do something a little bit similar, and that was 25%. But no one had really gone through the work of trying to do this at scale. So it is a relatively difficult problem to solve, and it's not the type of problem that has a silver bullet solution. You kind of just have to chip away at it and make sure that you have a system that allows you to kind of build on top of what you've already labeled. So I think those were the reasons. Like, crypto is still is a very young industry. It's a pretty hard problem to solve, and it might have been more, frankly, lucrative to do it for things like anti-money laundering and compliance purposes than for investing purposes. I still think that market's about 2 times bigger than our market. But we were, I think, from a purpose and mission perspective, more keen on helping, like I said, the man or the woman in the arena, the folks who are kind of at the ground floor, the pioneers. And that's why we decided to help that customer segment.
Yeah, got it. Fantastic. And I want to dig into a few of those points later on, but perhaps if we just stay at the top level, I'm interested to understand kind of the journey and the progress that you've made with Nansen so far. You founded the firm back in 2019. So what's been the hardest obstacle faced so far?
Yeah, I mean, there are a few things. I think now we've kind of, or we're probably still in a bear market, right? And so on the one hand, we of course expected to go through multiple cycles building in crypto. And so we planned for this. We raised a decent amount of money in the bull market when it was easier to raise capital, even if we didn't technically need to at the time. So we did 3 fundraising rounds in the span of about 1 year, from late 2020 to late 2021. But it's been difficult now in the last 18 months or 12 months or so with everything that's happened in crypto. Our plan was to invest and build when others had to potentially scale back. And we've had the treasury to do that. But most recently we had to cut the size of our team by 30%. Because of a combination of the organization being a little bit too big for where we were, and that slowed us down, and also because the cost base, was too high for the revenues we were generating. So that's definitely been the biggest challenge for us, to go through that, and we're kind of still, I think we're still in it, but we see the light at the end of the tunnel, and I'm very optimistic for the next weeks and months ahead. But I would say that's been the biggest challenge for us. I was really hoping that we would be able to get through this cycle without having to reduce the team. And that's something that we had to do very recently.
Yeah, absolutely. No, I'm glad we got onto that. I guess before we move on to kind of what separates Nansen from peers in this space, the name struck me as an odd one potentially, and I was interested to understand kind of why that name and how does that reflect the company's sort of mission or your values.
We view the folks who are pioneering the crypto industry, investors and builders, as somewhat analogous to explorers of new frontiers. And the name Nansen comes from a polar explorer, Fridtjof Nansen, who was the first to cross Greenland on skis in his 20s. And he also led an expedition to the North Pole later on. His ship was also used later on by another explorer called Roald Amundsen to reach the South Pole for the first time that any human had managed to get to the South Pole. And so I kind of think of our customers, our users, as the explorer, and then Nansen is the compass. And we are kind of you can think about this in different ways, right? If you can sort of imagine an Indiana Jones or a Tomb Raider, Lara Croft in the jungle, and they need to have, their night vision goggles or some kind of equipment to help them navigate like this dangerous territory, and where it's super important to be aware of all the risks around you and to stay alive, frankly. That's kind of the metaphor. We think of Nansen, the product, as someone who's with you on that journey, someone who's a companion that can help you navigate all of this, explore new frontiers, while at the same time hopefully staying alive. So that's kind of where the name comes from. And also Fridtjof Nansen himself was a really interesting person. I would highly recommend the listeners to seek out any biographies about him. Not only was he an explorer, he was a diplomat. He was a humanitarian who helped 450,000 people get passports through this program that he created. And yeah, he was just a great writer, incredible person. And maybe there's a little bit of an inspiration from the company Tesla, that's also named after another interesting pioneer. It's also 2 syllables, which is nice. Like tech companies like to have 2 syllables. So yeah, that's where the name comes from.
Yeah, fantastic. No, and I asked, I'd done some research. I did kind of understand the origins of the name. And the reason I asked, because although that's a fairly abstract kind of concept, this analogy or metaphor with the explorer, I think is actually quite fundamental to understanding the product that you guys offer. And that's what we'll dig into now. So to understand, I guess, what separates Nansen from peers in this space, let's tackle one of your core functions, and that's to enrich on-chain data with wallet labels. So firstly, why do that, and how does that help investors in this space identify new opportunities?
Yeah, this is critical because if you don't have that information, it's a bit like not having, if you're looking at using a web browser, and the only way you could access websites would be if you punch in the IP address. It's just not, that's not a very kind of helpful way to consume or use information. And with the wallet labels that we have, not only can you understand individual transactions, like the example I gave before, where you might see Alameda depositing $100 million worth of FTT into FTX, right? Or people, but also you can see aggregate flows. So actually, as recent as yesterday, a lot of people were monitoring capital flows out of exchanges, specifically Binance and Coinbase, because of the recent SEC news. And that's just not possible if you don't have the attribution of addresses to entities. If you're trying to monitor either Coinbase or Binance, you're looking at millions or even tens of millions of unique addresses. And to monitor those flows effectively, you need some way to map them back to the entity. So it's just it just makes the on-chain data 10 times more valuable. Like you could theoretically, many people talk about how they ask us about, how can you build an analytics or a data company based on fundamentally public data? But the public data is only the transactional data, right? It doesn't give you the insights that you need in the real world to understand capital flows, to understand what transactions actually mean. That's where we have this proprietary layer of entity information on top. So that's kind of why you need it. And you can set alerts for different entities in our product that you might want to get a notification every time there's a $10 million plus transaction going out of Binance, or anytime someone makes a large transaction for a token that you hold, but you only care about funds, for example, transacting. So it just gives you kind of a lot more flexibility and this interpretation layer that sits on top of the raw transactional data.
Yeah, got it. And giving that labeling is so crucial then. And with over, I think you mentioned 250 million labeled addresses already assigned, how does Nansen ensure kind of the accuracy, the reliability of that process?
Yeah, that's a great question. And I would say crypto has a bit of an information problem right now, where you see either charts that are frankly incorrect, or you see alerts that are misleading investors because the data is wrong. So quality assurance is something that we take extremely seriously. And it's one of the key things that the team spends a lot of time on. And there are different ways to do this. Like one is that we have our own processes internally, such that if people contribute labels to us, for example, our users might submit labels. We have techniques and people in-house that will review those labels and make sure that the evidence is convincing enough that we can actually go ahead and label an address. Every single label out of those 250 million plus that exist in our database has evidence and a justification accompanying it. So it might say something like, the reason we know that this address belongs to 3 Arrows Capital is because there are these 3 fundraising rounds for a specific token where they were the lead investor. And in all cases, when the tokens were distributed, the largest address recipient was this one. And so you can take a piece of off-chain information, in this case, like a press release, and then you map that back to the transactional flow manually, and you can tag the address accordingly. And then you can use that information in some cases to label it more addresses, right? So if that now sends funds to a Binance address, you can say, hey, and maybe that Binance address receives from multiple other 3 Arrows Capital addresses, then you can say this is very likely 3 Arrows' own Binance deposit address, right? So this is just an example. You can also study, you can literally, in some cases, be deterministic about it and create heuristics and algorithms that are based on on-chain transactions. For example, this is a bit of a trivial example, but if you wanted to label up all of the Uniswap pools, that's something that you can deterministically figure out based on the smart contract events that are emitted from Uniswap, the different deployer contracts and so on. Or if you deposit funds into an exchange, you can simply see where the funds go when you send it there, right? So that's also kind of a relatively deterministic way to figure out something. So yeah, I would say, the main thing is actually that every single wallet label has the evidence accompanying it, whether that's manually compiled or if it's referring back to which algorithm generated the label. And then, having people trained in-house who are experts at doing this is the second component, where, we have processes to quality assure every single label that makes it into our product.
Yeah, got it. And with 250 million already assigned, I'd imagine, although heuristics, manual investigations like the one that you just mentioned are going to be kind of core to your process, there must be some element of kind of automation that
That's
also
right.
supports scale. And with AI very front of mind, and given your background in this space, kind of where does that fit within the classification process exactly?
Yeah, so one way to think about it is that the majority of our wallet labels actually comes from automatic processes, whether that's algorithms or heuristics and so on. But the manual work is often spent on the more impactful wallets that are responsible for a lot of volume or activity, where you might need to investigate more. So it actually becomes kind of a resource allocation problem, where you try to send your human resources to spend time on the right wallets, which in itself is kind of a data, is an exercise that you use data for. So we have, our own dashboards internally to say, hey, these are super active wallets that we don't have labels for. Like, let's send some humans to look at those and figure out what they are. But it is true that, you just can't label 250 million addresses by hand. So the vast majority of those labels are algorithmically generated. But it has this lineage where we can say which algorithm generated it, and then we can also, of course, read the documentation on, how that algorithm was created in the first place. So yeah, that's roughly how it works. It's a combination of man and machine, which, by the way, like as a comment on AI more broadly, is how I see the next years evolving as well. That you have an AI co-pilot, and then you have humans that work alongside that AI, where the AI does like the bulk of the work, but the human's role is to prompt engineer it, to kind of guide it in the right direction and ask it to do specific things, and then quality assure the output, right? So even before ChatGPT, we were kind of working very closely with man and machine, hand in hand.
Yeah, absolutely. No, I was going to ask you for your more general thought on AI, so that's fantastic to get that. On your website, you describe a network effect that helps you exponentially almost infer more wallet labels as you go. So the more you get, the more you're able to infer. Can you maybe flesh that out? Tell us exactly kind of how that works.
Yeah. So the simple example would be, imagine you have 3 wallets that have transactions between them. If you don't know any of those wallets, like their identity or which entity is behind them, if you don't know A and B, and then you have a new wallet C, it's quite difficult for you to infer what is C. But if you find out that A and B are the same entity, they have a specific pattern by which they transact, and then now C comes along and C matches the same pattern as the other two, and they also transact directly. That way you can use the information about A and B to infer what's the entity behind C. And so this, simple example, of course, also scales out to much more addresses. So the way I think about it is, because we have this incredible library of wallet labels, it becomes a lot easier for us to tag up the wallets that are coming through the door tomorrow that are new, because we can simply look at how in the network of transactions they relate back to our already labeled addresses. So if you think about kind of two companies, like one has 250 million addresses, and then there's a few 100,000 wallets showing up tomorrow on different chains and so on, and you have to label them. It's a lot easier for that company than it is for someone who's starting from scratch or only has, say, 10 million or 50 million or even 100 million. And so that's that network effect, and it gives you kind of like a compounding advantage by just labeling out, because you can use the information about A and B to infer C.
Got it. And I mean, all of that, I guess, contributes to your coverage. I think it's 95% of all on-chain total value locked, which is incredibly sort of comprehensive coverage, I suppose.
Yeah, exactly. It depends a bit what metric you're looking at. So if you think about just general blockchain activity and attributing that back to specific entities, we're north of 80%. If you think about what chains we support, and again, you can look at like TVL or transaction volume, it's more like 95% plus. And for something like stable coins, which is a bit more concentrated, I think our coverage is 98 or 99%. But yeah, we generally speaking, I'm quite certain we have the best coverage in the industry.
Yeah, it would certainly seem so. No, but that's an important distinction. Okay, so The ability to follow smart money was also mentioned on your website. So tracking where funds are flowing strikes me obviously as a particularly important feature for budding sort of digital asset investors. So how does Nansen facilitate that tracking? Give us a bit more information there.
Yeah, so smart money, the way we see it, is also kind of a combination of two things. One is entities that most of us would consider noteworthy entities that you might want to follow as an investor. So this could be, one of the leading funds in crypto, right? Whether that's, Defiance or A16Z, or, other funds that are noteworthy. That's one class of quote unquote smart money. The other class is more behavioral and arguably more meritocratic. So it doesn't care about who you are in terms of an identity. You're only looking at your results in trading on chain. So examples here might be some wallet that has consistently been beating the market trading NFTs. They tend to discover NFTs very early. They mint them or buy them very early, and then they flip them later on with a profit. These are examples of wallets that even if you don't know who they are, you probably want to follow them because they're doing interesting things that you can learn from. So you can kind of think of smart money broadly as kind of a masterclass in trading and investing on chain. And instead of having to sift through the activity patterns of hundreds of millions of addresses, you can zoom in on the hundreds or maybe thousands of addresses that are worth following. And so this is kind of a curation problem and something that is also quite difficult to do at scale across chains, across different types of activities, whether it's yield farming in DeFi, NFT flipping, token investing. And we have different sort of behavioral categories of smart money too. Like I mentioned, NFTs is treated separately. Yield farming is another thing, but also addresses that are generating highly positive PNL, just trading tokens. These are the two categories. Basically, real world entities that we think you're likely going to be interested in because they're noteworthy funds and investors. And then the ones that are kind of behaviorally just creating such great results, even if we don't know who they are.
Yeah, got it. And just to make it a little less abstract for the listeners, like what does that look like in the platform? Are there features specifically set up to visualize this tracking of smart money?
Yeah.
Do you get signals based on those flows?
Yeah, exactly. So it's built into the product in a few ways. One is, imagine you're just seeing you're looking at some token, whether it's Aave or Wi-Fi or Uni or whatnot. You're looking at all the recent transactions. Visually in the table, we highlight the smart money addresses with specific emojis. And so it will stand out visually to say, hey, this is a transaction that you should probably look at because it has a smart money address involved in it. That also allows you to filter. So you can say, hey, actually, I don't want to see all the transactions. I only want to see those with smart money. You click one button and then boom, you're seeing all the smart money transactions. And then the third way is if you just look at aggregate flows, for example, exchange flows, instead of seeing all the players that are withdrawing funds from Binance or Coinbase, you can say, hey, I just want to see what the smart money is doing in aggregate, right? So that's the other way to think about it. And the mission of our company is to surface the signal and create winners in the future of finance. And smart money is a very clear way that you're surfacing signal. Instead of looking at all the flows, you're only looking at the flows of a particular small subset that you're likely going to be interested in.
Got it. And I imagine all of this sort of culminates in an ability to trace transactions down to a very granular level, more so than in other platforms, I would imagine. But also, I wonder whether you could provide examples of kind of how that more granular transaction level data has helped investors uncover insights that might have otherwise been missed. Is there a few kind of market examples you can point to?
Absolutely. I can mention two specific examples. One was one of our customers who had quite a lot of liquidity or had a lot of capital deployed into one of the curve pools on Ethereum for UST, the Terra stablecoin. And they had set up Nansen smart alerts to monitor that pool. And when they saw withdrawals happening very quickly and in large scale, they received notifications. I think it was through Telegram. You can set it up either for Telegram, Slack, Discord, or even custom webhooks. I think they got notifications through Telegram. And very quickly, they kind of jumped into action and withdrew their own capital from those curve pools. And literally within hours after that, UST, the Terra stablecoin, collapsed. And so they saved probably tens of millions of dollars just from those alerts alone. And of course, that paid for their Nansen subscription for life many times over. So it's a pretty good ROI. Another example is when this has happened a few times, but if you like investing in smaller cap coins and tokens, occasionally you can spot transactions that are made before they are announced by funds, right? So an example here would be there was a fund that did an OTC transaction with the team behind a specific token. So the idea, it's quite analogous to like a VC investment, right? It's more of the kind of liquid venture investing where you are you're buying tokens directly out of the treasury from the team. And they did this. You could see it on chain. It was a little bit convoluted because because of the way the transaction was set up with vesting and things like that. But if you knew how to read it and you were monitoring through our dashboard called Token God Mode, fittingly, you could see that transaction happening. And so this is something that would be considered a bullish signal for this token because this was a noteworthy fund that you probably want to have on your cap table. And a few days later, when they announced it, the token price went up something like 15 or 20% on the news. So if you were only watching what was happening on chain, you basically would have been able to spot this ahead of the news coming out. So conceptually, I think the way to think about on-chain analytics is that is literally where the transactions happen first, right? So if you're reading the news, it's going to be secondhand, like it's going to be after the fact. But if you want that first-hand, primary source information, you need to monitor what's happening on chain, and that's just one of many examples.
Yeah, fantastic. And whilst I wanted to cover the product and how you classify wallet labels, etc., that was always going to be the focus of this interview. I had to dig into kind of where we are in the crypto cycle. I want your thoughts on that, given the access and the wealth of information that you do have. So let's start with kind of the burning question. Where do you think we are in that cycle right now?
So my view is that the recent news with the SEC going after both Binance and Coinbase is probably like the final boss of this cycle. Depending, I think there are a few different outcomes that you can expect from this. My hope is that Coinbase will defeat SEC in court because, for a variety of reasons. If they do, I think that's probably, who knows how long that will take, but that will be a pretty clear sign of, brighter times ahead. It might drag out, so we don't know how long it will take. They might also lose, which is likely going to force them and other crypto companies to relocate their businesses outside of the US. But I think if you look at the classic kind of 4-year cycles of crypto, it definitely, this year definitely feels a lot like 2019. 2019 was a year where many people had sort of dropped out completely because they felt like there wasn't a lot of price activity happening, but there were a few pockets here and there of interesting sparks, both in terms of price pumps and tokens that suddenly kind of exploded and became popular. But it was still very much kind of the hardcore audience that was still around. To me, 2013 feels similar. And it does align, with the halving cycles of Bitcoin, interestingly, as well. Last year was frankly quite brutal, as we all know. And if you're still sticking around, that you're probably a believer that will almost stick around no matter what, given all the negative events that happened last year. And so I think it's the same if you look at price action either for Bitcoin or for Ether. It's been, I think, surprisingly resilient, given even the most recent news, right? You can imagine such news having a much, much larger negative impact on the market. But there's just been so much bleeding, and it's almost like only the hardcore believers are here. And so I think that's a sign of strength, to be quite honest. Like we managed to make it through a really, really difficult time for crypto. And I think we're at the tail end of this rough period where we have been, going sideways for a while. It's hard to say exactly when things will start be turning a lot more bullish, whether that's, a positive outcome from these SEC actions, or whether it's more application and usage driven. For example, some of these Web3 gaming projects that raised a lot of money 2 years ago that are finally going to ship games very soon, like literally in the next months. Or if it's, some new innovations that no one's really thought about that might be coming up, on the NFT side, on the DeFi side, or other in other sectors of crypto. So yeah, I would say it definitely. I would imagine that we are relatively close to getting back to a more bullish market, but it depends a lot on those factors. I do think you need to have a catalyst that kicks things off. I guess like maybe one thing that makes this cycle a little bit different is the macro environment, right? The macro environment is quite unique with regards to high interest rates, inflation. There's a war in Europe, etc. And crypto hasn't really gone through that. But there are also certain aspects to that which, play right down they are super consistent with the narratives that crypto have always been talking about, right? Excessive money printing, central banks, out of control, banks collapsing, bailouts that are needed, right? A lot of these events are exactly the type of stuff that crypto was created to be kind of the medicine against, and an alternative financial fabric that we're building. So that's the thing that's a bit different this time around, that a lot of these things that crypto enthusiasts have been warning people about, like they're actually playing out in the macro environment. And the role of the US dollar, the actions of central banks, the debt that so many countries have, the weakening of many fiat currencies. Like I'm Norwegian, and the Norwegian krona has just been taken a massive beating to the point where people are starting to talk about settling contracts in euros instead of the Norwegian krona. And many of these things would be kind of unthinkable just a couple of years ago, but there are a lot of issues with our current financial system, and crypto is the best alternative that we have, even if it is still a very young industry.
Yeah, fantastic. And it strikes me that, I guess, like with any financial market, institutional adoption is going to have a significant impact. And I wondered whether you had any thoughts on kind of this greater penetration of on-chain wallet transactions, better coverage of that, better labeling, etc., will actually lead to increased adoption from institutions.
I mean, I think the one thing that will increase institutional adoption is just regulatory clarity, which unfortunately the US does not seem to be providing. I'm actually quite optimistic on behalf of Asia more broadly. I think also the UK has a chance at offering more regulatory clarity and a more conducive environment for building crypto companies and so on. But that's probably the main lever that we have, right? Here in Singapore, where I'm based, just today, it was announced that Circle received a license as a major payment institution. I think crypto.com received one quite recently. Coinbase is present here. So I think, places like Dubai, Singapore, Hong Kong could actually benefit quite a lot from all this lack of regulatory clarity in the US. And Singapore, and Hong Kong as well, especially these two, are, respected financial hubs where lots of institutions are active. So I'm quite optimistic that these hubs will provide more regulatory clarity, and if they do that, then institutions will start getting more active. In terms of on-chain activity, there were some metrics that were pointing towards lots of interest from institutions. I think stablecoin usage and issuance was probably the main one. That's reversed quite a bit because the yields are actually higher in traditional finance right now through T-bills and so on.
Yeah.
But yeah, there are other. I think that maybe the one thing that's really interesting and might attract more institutional interest is staking, Ethereum staking in particular, which has had an incredible run up after staking withdrawals were activated. So I think there's some interesting on-chain data points to look at, stablecoin usage, yields associated with that, and also the staking economy, which I think is going to be super appealing for institutional investors too, given that you see all this weakness in fiat currencies. You have issues with counterparty risk. So finding other ways to generate yields but also on the basis of sound money, or in the case of Ethereum, ultrasound money, I think it's going to be quite appealing when the regulatory conditions become a little bit clearer.
Yeah, absolutely. That's the key. Okay, well, to finish, we ask all of our guests for the next big idea. That's a tagline we use on the podcast. So obviously, within your particular field, what are you most looking forward to? What are you most bullish about in this space?
Maybe a boring answer, but the whole Ethereum ecosystem, I think, is just the Ethereum ecosystem has shown that it can develop and improve and fix issues, and every upgrade that people have doubted, the Ethereum ecosystem has just crushed it. Maybe sometimes a little bit later with regards to the expected timelines, but still everything from EIP 1559, ETH staking withdrawals, like all these different upgrades, they've been crushing it. There's a layer 2 ecosystem that's coming to life around Ethereum, which is super interesting. There's the whole staking economy, where you have liquid staking derivatives or liquid staking tokens like Lido. I think that whole ecosystem is just super resilient, but also super innovative. So yeah, it's kind of a on the one hand an obvious answer, but I think that's the main sector of crypto that I think we've seen. Just it's proven time and time again that it's probably the most innovative and the most resilient and most active ecosystem. So I'm really bullish on the whole Ethereum ecosystem.
Yeah, no, absolutely. And it's certainly not a boring answer, definitely worth underlining. And I think that brings us to the end of the podcast, and it's just a fantastic insight, I think, to end on. And that just leaves me to say thank you very much for joining me on the show, Alex. It's been a real pleasure.
Yeah, thanks for having me. Happy to be here.